Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another week of Zen and the Art of Real Estate Investing. I know, I always say the same thing. We have a great show for you, but we do. And I hope that you think that every single week. This week we have Casey Franchini, but before I get to her story, I want to give you just a couple quick reminders. The thing that really helps us wherever you listen to podcasts is if you subscribe to the show. That helps our subscriber count. You know, whoever's looking at the data analytics, oh, it's me. That helps us know that we're growing. So I would appreciate it. While you're there, recommend your favorite episode to a friend. It just might help them get off the bench and into the game. Casey Franchini's here this week of Brick by Brick Wealth. She's going to tell you the story of how she went from buying a crack house all the way to the proverbial penthouse in 21 years. Let's go. This is episode 82 of Zen and the Art of Real Estate Investing with my guest, Casey Franchini. Casey is the founder of Brick by Brick Wealth. She's a real estate investor, a mom of three, and she's been doing this for 20 years. Can't wait to talk to her. Casey, welcome to the show.
Thank you so much. I am really excited to be here today.
Yeah, I'm excited to talk to you. And your journey has been a long one. When you first think of the time where you thought, real estate, how old were you and how did it happen?
Oh my gosh. Well, my dad bought a crack house.
Oh.
When I was in 8th grade. And that was the house that we fixed up for 10 years. And so I learned a lot, tons about how to fix houses. And I will tell you, I hated the Home Depot trips. I hated them with a passion. I hated having to paint and install windows and hang drywall and all these things. But I learned a lot. And once, the house was kind of done and I'm in my early 20s, I'm in college, I just had this it was just like, I loved houses. I wanted to see them. And living in Southern California at the time, in the early 2000s, there was tons of new builds, before the housing crash, tons of new builds. I mean, zillions. And I would drive 2 hours to see new builds. And so every open house that I would see, they allowed open house signs back then. Oh, they still do, but they don't out here where I am. So it's easy to go find open houses on the weekends. And I just loved houses. It was just something in me that just loved real estate. And it wasn't until after college and I had my first job and that didn't work out. And I said, you know what? I need something better, something more flexible, something that I'm in love with. Why not real estate? So I became a real estate agent in my early 20s. And I started finding flips for investors. That's kind of how it all started. And I didn't want to be a flipper because I thought, well, you need a lot of cash. And I was working with flippers that, were flipping $1 million homes. I'm like, I don't have $1 million cash. I didn't know about, those types of loans and creative financing at the time. So when my husband and I moved to, it was before we moved to Memphis, actually, when we were in California, we started making some offers on rental properties. But so I got in a long time ago and really loved real estate, but I always thought it was too expensive for me. So that was my early introduction.
Yeah, but that's a common theme. I think there's probably a lot of listeners who think it's too expensive, but then it's really market dynamics, understanding your locality. I think it's interesting, though. Do you feel like with that 10-year experience on the crack house with your dad that you soaked up houses? Because that's what happened to me. I went with my dad every weekend. We were looking at properties, the worst properties that anybody could ever look at. And I was in them all. And then again, early 20s, I was like, man, houses are cool. Like, I really like them. And do you still feel that way? I still love houses and I'm like old, but every house is interesting to me.
It's my addiction, and I think, well, everyone's got some addiction. My friend Jessica over here just drinks all day long. And I have another friend who's addicted to traveling and she spends all her money on travel. And I'm like, I don't. I mean, of course, I'll have, my Trulies at the pool and stuff. But, what's my vice? Like, it is real estate. I can't help it. I understand so many markets across the country, especially working with my coaching students, that it's just like, I love it. And I feel like if I wasn't just stuffed into real estate and just that was my day to day, I don't know what I would do. I would feel like I didn't have a purpose, but I absolutely love real estate. I love houses. I love the economics of the prices going up and down. I love the stability of the rental income. I'm not a big risk taker. And so for me, we invest in long-term rental properties. Like that is my bread and butter. That's my meat and potatoes. And it's like, that's how I'm going to save myself from not being like my parents and spending all their money their whole lives and living on the equity of their California home. Like, oh my gosh, I can just refuse to do that. And just real estate's been a great investment vehicle. And it's great that I love it too. Asking about stocks, I'd be like, no, thanks. Get me out. How do I get out of this room fast enough if you want to talk about stocks?
Well, we talk about that a lot though, because I don't enjoy stocks, but I like them a little, but there's no tangibility to it. It's just like a thing on a screen. Real estate, like you can go to it, touch it, you can fix it up, you can just hold it you could buy a piece of junk and just let it sit there for 20 years. That's like land investing, but you can do that with junky houses. Is it something about the tangibility that also lets you say like, oh, look, I own that and it's right there. It's not a piece of paper.
It's a lot of things. And people have asked me that before. And I think one portion of it is seeing like a project from start to finish. Like when I was younger, even high school and stuff, I was in student body, student government. And I was, I loved planning, event planning. And I used to want to be an event planner. And then I don't know, that never happened. But I did lots of events and I loved creating something from nothing. And that's what you get with real estate. You start off with a junky house and you fix it up and you use your skills that you have that we've developed over the years to fix it up. And now I have an asset. I have a little monopoly house, right? A little house on the board that one's mine and it cash flows and look what I turned it into. So it's great. And I think, I used to think, well, I want my life to be like Monopoly. Like I'm going to own every house on the block. That's my goal. Goals change, of course. But that was initially, I wanted to have little quote bank accounts all over the city where I'm going to hold my money. And they were going to be houses. Every little house is like a little bank account for me. And that's just kind of how we see real estate investing.
Yeah, when you first got started, were you thinking like cash flow? I know a lot of newer investors, they think cash flow first, but you don't realize how cool appreciation is. Like you get the cash flow for 5 years and then somebody tells you like, wait, you're up $100,000. And you're like, what? Yeah, now you can take a HELOC and use it. Is that something that you figured out along the way also?
Yes. So we wanted cash flow. And our initial goal was to not do the fancy refi till you die. We are not that. And a lot of people are refi till you die. But I am, let's buy a house that will appreciate. So we want two things, cash flow and appreciation.
Yeah.
And like a seesaw. And that's what I tell my students, do you want more appreciation or more cash flow? Which one's more important? Now, are you going to retire off $300 a month cash flow? No, you're not. That's not going to get you to where you want to be. What's going to get you to where you want to be is getting that cash flow, that small cash flow, whatever, every single month, but be in a neighborhood to where you close your eyes and wake up 10 years after someone's been paying your mortgage and you got a little bit of money in your pocket. And, oh, wow, it's doubled in value. That's how people retire, off the equity. So it's making smart investment choices. And if you go just for cash flow, you're going to be in a non-appreciating market.
Exactly.
A lot of Midwest homes and East Coast homes, especially some of the multifamily, they have high cash flow. But let's not forget some of the rehab downsides. But on the other flip side, right, they are in very flat markets. They go up, but really, really slowly. Yeah. And take into account the older, early 1900s homes with all those repairs that you have, you're kind of breaking even over time. Yeah, you got an asset and you've got some money to get your nails done and your hair did, right? But that's kind of it. You put so much money into the houses and they don't really appreciate. So the key is to be in those B class, the AB markets where you can cash flow, yes, not amazingly, but enough, and get that amazing appreciation that you can retire on.
Yeah, I love talking about markets, and I want to get your take on how you look for that market that's kind of the up and coming one. Like you can go on social media and on all websites, and you're going to hear all the big names. Everybody should go here. We got to go to Boise, got to go to Austin, got to do Nashville. But how are you finding the towns behind the towns? Because that's what I like. I like finding the town that's close, but not there yet.
So first, we have to find major metro markets, right? You want the areas to be sustainable. You want them to have at least 3 different types of employment. Not all tourism, not all hospitals, not all schools, right? 3 different major sources of employment. And usually these major cities are so big that when you open Google Maps, you're going to see dots and names. Like, this is how big they are. Not some tiny little city with a 20,000 population. So you find your major metro market, the draw. Are businesses coming there? Are there tax advantages for businesses to come here? Is population increasing or decreasing? What's the median income? What's the poverty level? I look at all these things for the major area, and then you look outward. And you want to be in a place that is going to increase in value. Well, what makes a place increase in value? Desirability. People want to move there, right? So what makes people want to move to certain areas? Yes, location, being close to the major metro area, right? Acceptable driving distance, but also quality schools and no crime. Those are the 2 key components that are going to get you a neighborhood that appreciates. So, okay, great. I found this neighborhood and it's $400,000 for a house. Well, that's not going to cash flow. Okay. So I have found that you need to be in a market that has single family homes under $200,000 in order to cash flow. I have yet for anyone to prove me wrong. Of course, if you put 100% down, it will cash flow.
Yeah.
But,
yeah.
Anything 20, 25% down, it should cash flow if it's under 200,000. That not anything, but those are the markets where you'll find cash flow. So you got to look for the good crime, the low crime areas, and the good schools. And you'll be looking in starter neighborhoods. Where are college graduates going to get married, going to start a family? Where are they looking? Where is the entry level neighborhood to the amazing city that they're going to go to Target and Walmart, Target and Kohl's, or, where's the Lululemon store? So what is the little tiny suburb or neighborhood in that amazing area? That is the area where you're going to find appreciation because you'll have more owners than renters. People are going to be fixing up the properties, increasing the value, and they'll be going from sometimes those gentrified C neighborhoods to B neighborhoods. So my opinion is kind of look for that. And that's where you'll find long-term equity growth over, 10, 15 years.
Yeah, I agree with that completely. I'm always watching to see, people use this Starbucks Whole Foods mentality, but it's because it works. They've done more demographic research than we'll ever do as, smaller investors. So they know. So if you can catch wind of something like that early or anything, Trader Joe's, something that's going to create that, that's definitely a place to look. But it's important that you said you still want to be near a metro. And we learned during the pandemic that, look, a lot of people they just made the jump out quicker because they didn't have to go back to work. But there's still always going to be the subset. I'm in Jersey, so we do a lot of business in Jersey City. They come from New York City to Jersey City or Hoboken, and then they come out to the suburbs where I am, and then they come further to the suburbs where I am now. And that is where you can follow the trajectory of what you said, appreciation with steady cash flow, if you can do it both ways.
Agreed.
Yeah. Well, so I know that you left California because it was going to be better in Memphis overall for family profitability. But is California such a tough market to invest for new investors because the price points are ludicrous?
Yeah.
Is that something?
It's not possible. I mean, it's really not. I mean, when we left there in 2013, so 10 years ago, a starter condo was $400,000. Like if I was going to buy a place, when I was in my late 20s, it would be a starter condo, $400,000. And I didn't make enough money at the time to pay for a $400,000 place. And, rents just weren't matching it. Now I have all my friends and family are still in California, still in Southern California. And the rents there are astronomical, but still not as high as the cost to buy the properties.
Yeah.
So, and besides even the prices of properties, it is not landlord friendly. I mean, tenants have more rights than you do. So why would you invest such a large chunk of your savings into a property you don't really have control over? I'd rather, put my money in a state that wants me there, that appreciates the value that I'm providing tenants,
Yeah.
California and other, states like that are just not desirable for the bottom line.
I'm in one, not not landlord friendly, very tenant friendly. But is that something
good there though? You can get good
yeah,
cash
yeah.
flow.
Yeah. There's ways to do it in all markets. I think you just have to, if you're a brand new landlord, you just have to be heavily vetting your potential tenants. You can always make a mistake, but heavier vetting. Every new landlord who I ever heard who said, you know what, I just took them because I felt bad. I'm like, well, you're going to pay for that. That's just landlording 101.
Yes. I mean, the big mistakes that I have made in my real estate investing career so far have been with tenants. It's not been not buying the right property. It's not been buying something that doesn't cash flow. It's not been underestimating or overestimating rehab costs. I was good with that stuff. I mean, I had the experience working with flippers, working with my dad. Like I knew that. I knew my market. I mean, I sold for people. I got that. But the tenants, that's what killed me. I have made some bad mistakes choosing tenants that's cost me tens of thousands of dollars. And I learned my lesson. And so, the better the quality of the property, the better the neighborhood, the better chance you have of getting a better tenant. So I am not about to buy any D-class properties. And really, even though some of the C-class are very enticing, I'm still like, I don't want to buy any more of those. So I'm a BAB neighborhood only buyer. And I know they cost more and I just don't care. So it's all, you're buying the tenants is what you're buying, and I don't want one that, goes from working at Walmart to Ashley Furniture to cleaning the floors at a hospital, like can't hold down a job, doesn't have responsibility, and it's just not reliable is what it comes down to. I need reliable tenants who have good ethics and are, honorable and will take care of my property and tell me when things will be wrong and they'll be honest. That's what I want. And to get that, I need more college educated tenants. That's just the thing. And to get those, they make more money. They can afford more rent. So I buy in better neighborhoods where I have a better chance of capturing that 700 FICO score, renter that makes six figures and buys Pottery Barn furniture. Like that's what I'm after. So if I want that demographic, I have to buy properties that they want to live in.
Yeah. I mean, I think that's important. I think you did mention it before too. I think trying to figure out who your ideal tenant is for your properties in advance is important. Who do you want to rent to? Who do you want to deal with? Because landlording is not fun. Nobody thinks it's fun, but you're going to have to talk to the tenants. So who do you want to deal with on a regular basis? And that's a really important goal in your landlord journey. I'm sure a lot of people see D-class with good cash flow, lots of issues that they don't think about that are coming in terms of deferred maintenance and things like that. But generally, the tenancy is going to be harder. You can get lucky, but you're saying now it's easier for you to hedge your bets on better properties, better areas, even if they cost more, because the overall value of the asset is going to be higher for all things, right?
100%. My equity is going to be higher. It's going to appreciate faster. And guess what? This is what people forget. People are so worried about year one cash flow. What's my cash flow year one?
Exactly.
What about rent appreciation? Hello? What about rent appreciation? Now, if you're in those CD neighborhoods, your rent appreciation is going to be very slow. And I have properties in C neighborhoods. And, over the past, let's just say over the past 5 to 7 years, maybe my rents have gone up 100 to 200 maybe a month. Okay. Now my B neighborhoods, $357 is my average bump. In the last 2 years, since the pandemic, my B properties have rent appreciated almost double than my C-class neighborhood. So people are so concerned, well, I'm not going to cash flow very much. Are you cash flowing enough? And can you count on a 3 to 5% rent increase year over year with those B-class neighborhoods? If you can, sweet deal. And your price point's going to be much higher. You might be talking about a $1,500 or a $1,700 a month rent. Now add 3 to 5% on that. Whoa. Now add some pet rent. Whoa. That's just really increasing your monthly income. I love pet rent too. And it's so sad when some of my students pet rent's not typical in whatever area. I'm like, oh, that really sucks. Dang it, because that's really great. I have one lady, I just always knock on wood, I have one lady, I put her in recently, and she has a farm that I call it. She has a farm. She had 3 dogs, a cat, and a bird. And normally I'm like, I really don't like animals because they just can do damage. And, it's not the animals that do the damage but it's the pet owners that don't take care of their animals. That's where the pets do damage. But, you can't tell, I'm a great pet owner, says who, your mom? I mean, I can't trust, so. But anyways, this lady, she's a Walgreens pharmacist. She has a 750 FICO score. She's moving to be closer to her kid who just had a baby. And I'm like, okay, you sound like a good person. You're honest, right? You can take care of your responsibilities. You make more than is needed. I will allow your pet farm. However, you're not getting a discount on pet rent. So now one of her pets literally just died yesterday. So that pet's coming off, but she pays 110, 120 bucks a month in pet rent, something like that.
Yeah. If for solos, we're usually at 50, and then like sometimes cats are 25. It really depends on.
Yeah, that's what I do. So I do like 50 for a big dog, 40 for a little dog,
exactly,
25 for a cat, and I'm not charging for her bird.
Yeah, I mean, pets is really a thing that, I mean, like if you have like a brand new, perfect turnkey, high end, then like maybe no, but everything else, I think yes, because you can get way more rent. And I'm not saying like all pet owners are going to be great pet owners, because they're not. But like you're saying, if you're going into higher end rents, usually those pet owners are going to be more careful. There's a barking issue with dogs, but that's something to consider. Do you go through that dynamic with your students? Like, hey, pets or no pets, or like washing machines, 1 or 2. These things are all important for people to understand. Then I think they don't think about it a lot before they buy. They're almost like brand new landlords, and if they haven't had training or they've only watched YouTube, like they can be wholly unprepared for what's coming.
Absolutely. And pets are finicky. And what I've learned is I've not been a fan of pets. I don't really like dogs personally. I'm not a dog person. I have one cat named Rambo, king of the neighborhood. He's a great cat. He's amazing. But he's indoor outdoor. He's got his own cat door. So no litter box for me. Like, get out,
The best.
I don't really like pets. So I have learned, though, that if you don't allow pets, they're going to bring the pets anyways. And you're not getting paid for them. So,
great point.
Okay, fine. Go ahead, allow pets. But you're paying for it, because if I say no pets, you're going to sneak. I mean, 3 tenants have snuck pets, and I'm like, hello, knock, knock. I see your pet through the window. Now you got to pay me pet rent.
Yeah. My favorite is when because we represent a lot of landlords. I have an on-market team as well. And they'll set the showing and they'll say, oh, I saw it's no pets. Are you open to pets? They're like, they have a cat. And I'm like, no, these landlords are hard no on pets. And they're like, well, we'll still do the showing. I'm like, I mean, you're just telling, you're not going to like give away the cat. So what are you doing? It's coming. They're going to sneak it in a blanket or something.
No.
Yeah.
And also the other thing, since we're on the landlording topic, the other thing that has damaged my properties is smoking.
Oh yeah.
Oh my God. So what I do is, since I landlord my properties, I listen to what they say. No smoking, I say all 100 zillion times. And then I meet them and I go, I give the sniff test.
Right
if
away.
you smell like smoke, I'll say, and I am not even care. I'm not afraid. I go, I thought you said you don't smoke. Oh, well, I smoke outside. No.
Yeah.
Okay. I've said, okay, before. And they smoke outside for so long until they go, my landlord doesn't visit my house every day. I'm having a bad day. I'm just going to smoke inside, or I'm having some friends over and they are used to smoking inside. And so now your house smells like smoke, and it costs, a whole paint job and maybe flooring removal to get rid of it. It's very expensive. So now I tell my tenants, look, this is a hard no on smoking. If you used to smoke and you start smoking, whatever, I don't care. If I smell smoke of any kind, it's going to cost $5,000 to repaint this place.
Yeah, with all the extra primer. Yeah.
Just so you know, if you smoke, it's going to cost you $5,000. I'm not going to pay for it. And that, having a price tag, because they don't really, they think, oh, well, I can paint the house. Like, the paint's not that expensive. Yeah. You go ahead and have someone paint the house. It's going to be several $1,000s. And if there's carpet, just forget that. That's just got to be removed.
Yeah. That's my one biggest pet peeve. Even I can't show houses that have ever been smoked in. I can't even go inside. But I think that's important. I mean, and it's also like, as a landlord, you have to understand what things are protected class, like real service animals, nothing you can do about that. Emotional support animals, not protected. But P.S., smokers are not a protected class. We don't care. Nope. I don't want them. I'm sorry for anyone who's a smoker, but like it's a bad investment in your property to allow it. And I think it's something that, again, you might not know because not everyone's going to be honest. But for, that's for if you're not on site or in the area, then your property management needs to, like you said, sniff it out.
Hey, this is Jonathan. Thanks for listening to another episode of Zen and the Art of Real Estate Investing. On this brief interlude, I wanted to tell you that we have a mailing list. I actually don't love mailing lists. There's so much. This is not an automated mailing list where you get on a drip campaign. These are written once a month, will eventually be at once a week again by me, direct, and they're not spammy. So if you want to sign up for our mailing list, you can go to bit.ly/streamlined with a D mail. Bit.ly is bit.ly/streamlined mail. See you there.
So how did you get going on your journey to get to, are you strictly single family rentals or did you ever go to multi?
So out here in Memphis, there really is not any multifamily. And the multifamily that there is, it's in the hood and you don't want to buy there. Either that or is some beautiful high-rise, expensive condo buildings that I'm not wanting to invest in. So there really isn't any, small multifamily out here. Now I have students that invest in the Midwest a lot and even some in New Jersey and New York, which I wouldn't go there on my own because of, it's very tenant friendly. But a lot of those properties in the Midwest, which I help my students with, they are older and man, those early 1900 houses come with a lot of maintenance and
structural.
Structural basements. No thanks. So, and the cash flow is there, but again, the appreciation is not there as much, at least for small multifamily.
Yeah.
So I'm happy with single family and my rents go up pretty nicely and my appreciation, like the values goes up really well. And I prefer it. I'm not opposed to multifamily if there was a good deal and it was the right property. And I have a lot of students that buy multifamily. But for me right now where I am, I like my single family.
Yeah, I've always been a single family investor. All we did, short-term rentals before Airbnb existed. They're just steadier for me overall. I feel more comfortable. And we've owned a lot in HOA developments like in Florida and even in parts of New York where that little extra bit of maintenance. What do you think for first-time investors? Does a condo, is that something that you would recommend to them because it's a little bit safer with the HOA? You pay a little more, but you're not fixing the roof, you're not fixing the windows.
I wouldn't necessarily go recommend it, but if there were, opportunities near them that cash flowed, always near is better. And I teach new investors what never bought anything before, sometimes not even their own primary, how to invest. And most of them are out of state investors. But if there is an opportunity near you and it's a condo and it cash flows, I'd go with the condo, I wouldn't say go to a condo because there's less exterior maintenance and things. No, to me, I don't really think of that as a factor. The things that I do consider with condos are the HOA, what you get with that, and if there's been any special assessments recently, because you'd hate to go buy a condo and then next year, hey, everyone in the complex, we got a $5,000, assessment because we're putting on a new roof and a new pool. It's like, dang, you got in at the wrong time for that. So I'd like to make sure, first of all, the condo is warrantable, that there's enough owners paying their HOA dues and that my lender will lend on it and it's going to stay uphill because of condos, sometimes like apartment complexes, they tend to get kind of run downhill over time. So you want your equity to be there and have it still be appreciating. So you need a healthy HOA that's got mostly dues paying members, looks nice, doesn't have a lot of dilapidated patios and roofs and common areas. Everything's got to be real nice. And I still don't want to overpay for the HOA because that's just one more variable that affects your bottom line. Besides property taxes that go up, besides home insurance, now you've got HOA dues also going up. So if you do have a condo, you're going to need a healthier cash flow. You need a thicker, bigger cash flow to absorb some of those increases you're going to have.
Yeah, great advice. In terms of out of state, how are you helping people identify the markets? And then when they choose a market that they like, how do you help them create this funnel where, they're at least going to have opportunities to work with the right people? Since you're in Memphis, you can't be everywhere. Obviously, a lot of us have connections everywhere, but building that area funnel is really important.
It is hard. And in my coaching program, which, I didn't come here to talk about it all, but it's one-on-one. And the whole beginning part of it is really focused on market research. So there's a whole thing. We first go through understanding your financing options and what you're capable of buying and how you intend on financing it, whether it be a DSCR loan, conventional, or some other thing. Where are you getting the funding from? Do you need to borrow from your 401k, or do you got to get a HELOC first? You have cash, all those things. What type of property do you want to buy? Is it need a fix? Are you cool with a fixer? Do you have cash to fix it up, or is your cash limited to where maybe you need something more turnkey and more rent ready? So figure all those things out first. Will help determine maybe where better market, where good markets are compared to ones, well, they won't be for you. And then we look for major metro markets, right, that meet our initial criteria. And a great, place to start is if you already have a boots on the ground person somewhere, if your aunt lives in wherever, your cousin lives wherever, or you went to school wherever, if you've got somebody there, that's a huge plus. That area will get to the top of your list super fast because you have somebody for an emergency you can lean on. So that's, first criteria.
That's fantastic. I've always said, I think people should make a list. Every place you've ever lived, all the places where your best friends and family live, and then see if those cross over with markets that you might be interested. There's always going to be a crossover. We always bought what we were going to use as short-term rentals, always where my sister's best friends were. Because their markets were good. They lived in good areas and they would help manage it and it would be easier. Yeah. So in terms of, I really think what you said about doing that intake one-on-one for your coaching program is important, because that helps you not waste time. I think as people who deal with a lot of investors, we get a lot of people who ask questions, even if they're paying, sometimes they just can't get to the point. They're just like, well, I just want something that cash flows. Okay, that's really impossible. That's a bad use of your time, right?
That's a bad way to go about that,
agree.
And a lot of times people are seeing the shiny object syndrome. It's like, okay, well, this guy says I should do short-term rentals in Texas. This guy says I got to do the Burr method in Atlanta. This guy says, it's like, okay, well, you're never really going to be you're never going to have that confidence to pull the trigger if you're not really invested in what market you're going for, and you don't know all the answers. Like, it's already hard enough to fathom buying something out of area when you've maybe never been there. Yeah. Now throw in the fact that you're going to put, $30,000 to $50,000 of your hard-earned money into a property, and you will never see it. And you have to trust people that are there to make the right decisions for you, your team. It's like people get stuck so fast on what market because they have no clue on what's important to them. And, just because Timothy over here is really wanting a D-class neighborhood because he wants the cash flow and he's going to take the risk. And you're like, okay, I'm going to do that too. Because I've heard so many guys are making it, in Detroit, that's the place. I'm going to go buy these $30,000 properties. I'm going to buy all on a credit card. Okay. So there's like that. And then you go there and you're like, okay, I'm going to do this. And then you go, well, this doesn't really feel like something I'm comfortable with.
Yeah.
So you got to learn what's good for you to do. What kind of investor you want to be? What's your risk level? How much finances do you have? What time do you have invested? And what is the type of investment that will work for you? Because everybody is different in what they invest in and why.
Yeah. And if you don't like the investment or the area, you're not going to be interested in it. You're just going to let property management do it and check out from it. And that's just pouring money into a hole. You said something important, though. I think this is really something, especially you have big social media following. Like, there's so many shiny objects out there, and we find people that we know always, falling in the hole. But it's not really their fault. It looks pretty good online. How do you separate yourself, and how do other people know, what's real, what's not real? How do they connect and make sure this is an okay program? This is going to work for me. Because we all know there's a lot out there and it's not all good. And not as many of those people as people think are actually doing the long-term real estate investing for themselves.
Yeah, I would say, there are so many courses and programs, and it's ridiculous. And I'll tell you, before I started doing all this coaching business, I had no idea that those things existed. It was my sister who told me, Casey, you should do this online. It was right before, right in COVID. And I was helping people locally, but then that ended. And my sister was like, Casey, she's so much younger than me, you should do this online. I'm like, I was a big no for me right away. But I think, a lot of the success from my program and my students just comes from the fact that I truly want to help people and I'm willing to help them personally, I still am a mom of three. We came from a single income. My husband was not making six figures. I get that all the time. Oh, well, you were a stay-at-home mom, but how much was your husband making? Blah, blah, blah. I'm like, not even $100,000 a year. Okay. So, and we still did it. I don't want to hear it. So it's like, I know what my rental properties did for me and how it changed my life. And I love, just like I told you, I loved event planning. I love a project. It's like my students are my project, and I get to see them from these situations where they're, working to death, and they could be anywhere from like 27 years old all the way into their 60s. And they're just so tired of the grind, and they've never saved enough in their, 401ks or whatever. They know there's got to be another way. And helping them realize, oh, wow, there's another option for me. I can take my savings and invest it and have my money work for me, and help them personally through the process to get them a successful property. It just makes me feel good. Like that's my extra. Yeah, I charge, but my other benefit is it gives me that I'm helping and changing people's lives.
Yeah,
And
I mean, that's it.
People are just like money grabbers, but I like to help people. So I don't know.
I think you can tell, though. I always say, like, I really think that listening to us on podcasts and listening to different podcasts, you can get a real idea in 60 minutes whether somebody's, BS or not. You just know, like, that they're not pausing. They just know stuff about real estate and they just keep talking. I think that's why podcasts are another reason why it's a great starting mechanism. But then, of course, then you got to go do your vetting, look up online, make that first appointment, see if someone actually cares. And I really think, like, the cost is irrelevant. You could pay. I've heard of $50,000 programs that are an absolute disaster, and then $50,000 where people did crazy. But even if the materials are there, I've found that a lot of programs are user error. Have you found that? You're probably really good at vetting up front, but I find people who complain about a lot of coaching programs, just to say pro for these for a point, it's just because they don't do what they just think the money's going to fall. Exactly. They either don't have the time or they want everyone to do everything for them. And you can't learn anything like that. So then you're going to make bad decisions. Yeah.
I've talked to a lot of people who've come from other programs, and they're like, oh, I did this program and that program, and I bought that course and did that course, but I still don't have a property. And it's like, they don't even have to tell me why. I already know why they weren't successful with other programs. It's because as soon as you get a hiccup, as soon as you get stuck on some point in your path, your journey to buy the rental property, you get stuck on a point and you don't know what answer to go with. You don't know what choice. Is this a good choice or a bad choice? So you make no choice, and then you don't make any progress. That's it. So having someone to get you through those obstacles and keep pushing forward is what is needed. And a lot of these massive group programs, there's online courses. I've got a course too that comes with my coaching program, and you can sure enough find all the information online, spin your wheels and spend a lot of time. You could do it. Information's out there, but a lot of times too, it's information overload. And it's when it comes to your specific situation, what do you do? And that's when people, they like clam up like, oh, I don't know. Yeah. This situation wasn't covered in that, video that I watched. And so I haven't seen this example before. It's like me with math. I hate math, and I'm so glad real estate's easy math. So it's like adding and subtracting. I can do that. I am a reader. I love to write. And so in school, when I was in calculus and all these hard math classes, and I would get to the test, right? I understood the homework. I understood how to do X, Y, and Z step, but I couldn't put X, Y, and Z together to make L. And so that would get to me. I understood the individual components, but then putting it together, I was stumped and I couldn't progress. So that's why I decided for the minor in business instead of the major, and went with communications major instead. Yeah. But it's like that in real estate. You understand individual components, but when it's time to put them all together and there's a new situation, you don't know how to answer that. Yeah. And that's where people get stuck.
Yeah, I've always been we do meetups. I think meetups and these communities inside the coaching programs are really where it's at. It's where people meet so many partnerships, and you find somebody who's doing like exactly what you want to do, and they're just one step ahead. But that also means that you're just one step ahead of the next person. So then when you can help somebody else, you help yourself. And that's where I really think you can tell where the real communities are, because that's how you can eventually scale your growth, within a time frame. So, I mean, the last couple years have been crazy for real estate. Now rates are high. When you have new students coming in now and they're trying to figure out financing and what to buy, I know you do this long intake interview, which I think will really, really help. But like for someone who's listening now, who's like, I really want to get into it now, what would be the first thing that you tell them to do to kind of get ready right now?
The first thing I would say is, do you have, well, first of all, are you in consumer debt? Do you have consumer debt? You have high credit card bills? No, not ready. It's not time for you. You need to get your own self in financial order first. And I got a lot of people that say they want to join my program, and I go, your credit sucks. Like, you need to have a 680 or above. You need to have some savings, or at least be able to borrow from a 401k or have equity in your home. You need to have some of your own money to invest. You need to have a good credit score, and you need to have the time ready and be willing to buy a property. So many people go, oh, I want to learn, but I don't want to buy anything. It's like, well, then what's the point? It's like, you got to be ready to go. So if you're thinking you want to buy a rental property, get yourself financially ready first. You can talk to a loan officer. Don't be afraid. Loan officers, a long time ago, I used to think that they're like used car salesmen, and they're going to like snake oil you, and they're going to lie to you, and they're going to try and cheat you. Not true. Not true. Loan officers are great. Just don't let them run your credit when you talk to them on the phone. Okay. So I know got a whole thing about that, but talk to a loan officer, give them the verbal over the phone, how much you make, how much you pay in your credit cards. If you got alimony or child support or car payments or whatever you pay, don't leave anything out.
Don't leave anything out.
And they can give you, an over the phone kind of estimate of about how much you might qualify for. And that would be really helpful. Now, one thing that they'll ask you is, well, what price house are you looking to buy? This is the mistake people make. They say, I'm looking at something $100,000, right? Or whatever. And they type it in their computer. They go, oh, if you're qualified, you can get $100,000. And you go, great. So now you're looking around for something that's $100,000. What if you said, Mr. Loan Officer, what's the maximum amount I'm qualified for, regardless of my down payment situation? What's the maximum I'm qualified for? And they go, oh, 1 million. What a difference, right? Now, oh my gosh, that opens up lots of possibilities. That means you're qualified for $1 million in purchases, and all you got to do is come up with the down payment. You don't have to get a new job. You don't got to get a second job. You don't got to get a raise. You don't need to make more money. Well, maybe if you want more down payment, but you can do seller financing. You can, use private money. You could do a lot of things if you're qualified. So I think one mistake people make is just asking for the minimum of what they think they want to buy, when really, if you know your max, it can help put you on a different path or maybe a different market entirely based upon your individual factors, like what you're qualified for, your savings rate, how much cash you have, any assets you have you can liquidate if you want to, like brokerage accounts. So asking for the max, I think, is a good place to start and talk to a lender.
Yeah, that's fantastic advice. I think it's really great if you just go back to your first point, is like, make sure that you're financially ready for this. Clean your house up first, meaning your financial house, and get ready. That's advice for people who, that means like you care about them. Because like, there's no reason why you should be trying to figure out how to sell or finance a house when you have a 540 credit. Like, you're already in trouble. You got to get that up. It's like when people say, well, I want to quit my W-2 and I want to go and be a real estate investor. I'm going to start with wholesale. I'm like, how much savings do you have? They're like, oh, $3,500. I'm like, well, where do you think the income's going to come from?
Just go ask for your job back.
Yeah, exactly. Keep that W-2 as long as you can and figure out how to maximize the time. That's really great advice. And I think it just shows that, focusing on the person and trying to make sure they understand what their why is in the beginning is the only way that you can really help them. Because then there's no way you can help them if they don't know. Then it's going to be just a big waste for everybody. And that's why I always find it hard when people ask me like, hey, you tell me where to invest. I'm like, I can't tell you. I don't know what your appetite is, and I don't know if what you're saying about your money is real. Is that vetted money? The people say, oh, it's a cash. I have cash. I'm like, what are you referring to as cash? Because to me, cash is cash that you have in the bank. Cash isn't hard money. It's not private money. That's adjustable cash that you can borrow. But like, hard money still comes with a mini appraisal. It's a different kind. But like, that's where I think you figure out who's ready and who's not.
Yep. And I asked too, how much do you, and some people go enough. And I have to go, look, I know you think, what do you think I'm going to do? Charge you more when you tell me how much you make?
Right.
I'm not. like I need to know that you have enough money to buy a rental property. And it'd be great if you could buy 4. I could help you with 4, but I need to know, like I've had someone so my minimum criteria is you have to have between 30 and 50K somewhere, right? You need to have at least a couple thousand cash for your earnest money, but you got to have 30, 50K somewhere to buy a rental property. And someone said enough. And I was like, okay, well, I don't want to ask, how much is enough? Because then I'm sounding like, how much you have. And so I didn't ask. I joined the program and they had like $28,000. I'm like, that is not enough. That's not enough.
Yeah.
So we can do it. I mean, I have students that buy properties for way less than $100,000 properties that need 30,000 minimum. I'm like at 65, 80,000, but I can't promise that. And I hate taking people on that I've got to find them the cheapest thing out there. Because now they're compromising
it's
quality.
tight though. Yeah. It's also tight for them if they're spending all of what they have in savings on this first opportunity. That's funny though. I can just imagine, sending over a pre-approval on an offer and it just says enough. Pre-approved for enough. Oh, thanks. Okay. Definitely going to accept that. But that's part of the education thing. I think when people get in, especially if they're already like in the program and they don't want to tell you, that's like, just, get out the red flag. We already know we're going to have a problem.
It's happened a couple times. I've helped a lot of people a couple times. They just want to say enough. And I'm like, oh my God, get over that. Just tell me. I can help you much more if I know like your capability of investing, And then I'll have the students that'll go, I have $1 million. And I said, cash? And they go, yes. And I go, you mean like in your savings account? And they go, yes. I go, naughty. That's too much to have saved from cash. You're losing last year. You're losing 8% of that every year to inflation. You didn't realize that. Keep what's comfortable, but you got to spend that quick on some real estate.
Yeah. Get it out of there. I suffered from that though. After the big economic downturn, I got scared. I was just like hoarding cash. And then I was like, that was stupid. But, it was mildly safe at the time. So tell us a little bit more about Brick by Brick Wealth. I know we've been talking about it the whole time. You started that during the pandemic. And what do you do? How does it work for people? And then where can they find you?
So Brick by Brick Wealth, it's my motto. It's brick by brick, you will get wealthy. One house at a time. Don't think you need to start with a 40 unit complex. You've got to start with a hotel. Dude, keep it simple, right? KISS method, keep it simple, stupid. Let's start with something. There's so much to learn first before you go crazy and go creative financing and before you start buying multifamily, large multifamily. Let's just start with the basics. Single family or small multi, up to 4 units. Learn how to do it. So I teach people how to do that. My main platform is Instagram. You can find me at Brick by Brick Wealth on Instagram. Also, I'm starting my YouTube channel back up. There's some real oldie videos on there.
Got to keep those. Those are fun. Yeah, those are fun.
Too. I just look so good. I've gotten so much better, on camera over the past several years, but it's funny. And then you can find me on my website if you want to learn more and, see all the things that I've been doing. It's brickbybrickwealth.com.
Yeah. And so one more question that I think maybe will help some investors figure out what to do. If I know you say you'll do the intake and then you'll see if they have an appetite for rehab, but if you just like disregard that and say, would you recommend now that people should go to something more turnkey as a first investment or rehab? I know what I think, but I want to know what you think.
I think more rent ready. So turnkey has a weird,
I agree.
has a weird feeling to it. So when people say turnkey, right, really they mean it could be misinterpreted as a turnkey company that sells you a fully rehab property with a tenant on a platter, and here you go. So when turnkey, I don't like to say because it implies buying from a company that's handing you it all together, and I'm not a fan of those, even I won't even say. So more rent ready is what I go for. And I have fixed up a lot of houses in my time. And personally, like we fix up houses and I've had contractors that have helped us. And I will tell you, even if you get an amazing recommendation from someone for a contractor, they're going to have done a good job for that guy and not a good job for you. So you need to start small with contractors, give them tiny jobs. Instead of renovating a whole new kitchen and doing a new layout, why don't we start with them replacing the countertop? Why don't we start with them doing some little things here and there, subcontractors, not even really big contractors. Give them some little jobs for your first property, tiny things. Then graduate into bigger and bigger projects once you've built that relationship and they know you're going to pay them and they're going to show up and do the work on time and as expected with proper documentation. So I say start with something more rent ready. You can do some cosmetic stuff, paint, maybe some flooring, maybe fixing up the bathroom, new toilet vanity, But let's not start with a burr job with a down to the studs remodel out of state for your first deal. It just spells disaster.
Yeah, I really think like it's like 10,000 and under, preferably 5,000 and under for like more of like a lipstick flip. But that's just like it's a better, safer thing. And I do feel like at least for me as an investor, I understand people want to put a little bit of their own spin on it. So that's why that like 5,000, just like, fix up a little bathroom, swap out, a countertop. So they feel like they've done something. But I agree, don't bite off more than you can chew on a first one. It's just going to be a disaster, especially now. Construction costs are still up. Contractors are wholly unreliable across the country. And if they know you're brand new, they're going to take advantage of that. What you think is going to take a week is going to take a month. It's going to take 2 months. So,
and the charges will be through the roof.
Yeah, exactly. This has been great advice. Thank you so much for being here. It was great to finally meet you. Hopefully we'll meet in person one of these days as well at one of these real estate investor things. But I really appreciate you coming by.
Thank you so much.
All right. That was Casey Franchini of Brick by Brick Wealth. I'm Jonathan Green. This has been episode 82 of Zen and the Art of Real Estate Investing. We'll see you next week. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.